Now this chart here is one of a couple of charts that I call the greatest chart in the history of the stock market. And by the time I finish explaining, I have a much more detailed video that I did for my son in this, but this one I'll probably just stick in YouTube. This chart here in this pattern is forming a megaphone. It's essentially 100 years old now. And that shows you how valid the pattern is. We're not talking about weeks and months here or even decades. We're talking about a century. And what it refers to is the fact that a lot of people talk about buy and hold. Well, buy and hold is a bunch of crap to me. Buy and hold is okay if you're switching cycles. Every second cycle you should not be in the Dow. You should be in commodity stocks like gold and silver as an example. And I'm going to show you some data here. From the 1929 peak, where the Dow stocks lost 89% of their value in a super cycle decline. You know, you've got super cycles and then you've got regular cycles. We are now back in a super cycle decline, which means if it fulfills its destiny, I'm sorry, but the Dow is just going to get murdered. And I fully expect that to happen over the next decade. But going back to 1929, just follow this right here, and I'll just check to make sure you can read that. I'll try and go in a little bit closer on that, just one sec. There, I think you can pretty much see this. If not, the chart is in the files. Homestake Mining, which was the largest gold company at that point. Remember, mutual funds didn't come into existence till the mid-1950s. I think John Templeton set up the first one, or one of the very first, the Templeton Growth Fund. 1929 to 1940, gold stocks up 614%. The Dow, over the decade, lost 71%. It lost 89% from 1929 to 1932, by the way. Then from 1940, gold stocks lost 28%. The Dow is up 800%. From 1966 to 1980, the Dow went nowhere for 17 years. And by the way, in the 1929 cycle, the Dow went nowhere for 25 years. In other words, the 1929 price, it took 25 years to recover that price level. So don't tell me buy and hold is a practical thing to do, because that is a large portion of your working life. So from 1966 to 1980, the Dow went nowhere. Gold stocks went up over 1,000%. Then in 1980 to 2000, gold stocks got massacred, which was predictable by the life run patterns in the UserX. However, even though gold stocks got killed, the Dow is up 1,075%. Here's the catch. Just follow right here. This is just pure, simple math. Not complicated. You don't have to be watching every single day, but just pay attention to this chart. When this chart is at the top line here, you sell the Dow stocks and you buy gold stocks, or silver stocks as an example. When it's at the bottom, you buy the Dow stocks. Now the Dow gold ratio means you take the price of the Dow and you divide by the price of gold. Let me give you an example. You can see when you're looking down here that the ratio is pretty close to 1. You know, maybe it's in the 2 to 1. So the price of the Dow and the price of gold are virtually identical. And then the Dow runs away up, and then the ratio becomes imbalanced, where the price of the Dow is very high and the price of gold is very low. So let's assume if it's 1970, maybe the Dow's in the 800 to 1,000 range, but the price of gold is only $35. So by the 1980, what happens? The Dow is in the 1,000 range, and gold intraday was in the 850, 900 range, something like that. So it's pretty close to even. So just follow me on this so you'll get this, and watch this over and over, print it, explain it to your kids. I don't go into the same detail here because YouTube has a 10-minute video limitation. So, I mean, I think the video I did on this for my son's probably an hour long. And I think in YouTube I may have maybe 60, 70 videos. I have 150 altogether, and some of the videos I did for my son are in the 2-hour length. So you can get a sense of how much more detail is actually going to be there. Now, getting back to right here, when it's at the bottom, you sell gold stocks down here and you buy the Dow. When it's at the top of the line, you sell the Dow and you buy gold stocks. The same thing at the Bottom here again, what is the year? That's 1970. You could actually start that 1966. 1980 at the top, you sell gold and you then buy Dow stocks, and the Dow runs up, you sell the Dow stocks and you buy gold stocks. Before this cycle is done, we are now in, just to go back one step, in the year 2000, we know, if you study the Dow-Gold ratio, go on YouTube or go in Google and research it, and you'll be stunned at what you'll come up with. If you, in the year 2000, take the price of the Dow was 11,007, you take gold at $252, you know that during this cycle from the year 2000 onward, that the price of gold and the price of the Dow will be virtually identical. But what's the problem? You've got the Dow at 11,007 and you've got gold at 252. So what has to happen? The Dow must stay the same and gold go up to 11,007. Or the price of gold will stay the same and the Dow will have to crash down to 252 from 11,007. Neither one of those seem practical, so it's going to be a little bit of both. Because we're in a supercycle decline, I fully expect the Dow may be in the 3,000 or 4,000 range before this down cycle is complete. If there's a complete wipeout, then the Dow may drop down to the 2,000 level. And I've seen Elliott wave analysis on that, but let's just wait and see. I honestly don't care. I can judge this based on... Came across an interesting little article that I just took a digital photo of, and it was talking about the fact that this is now January 2010, that the gold rally has a minimum 7 years to go. It completed 5 waves up to 1227 for the price of gold, and remember that was 250 in the year 2000, but that move is only wave 3 of a larger wave 3. So you've got wave 3 and it goes 1, 2, 3, 4, 5. Wave 1, 3, and 5 are up. Wave 2 and 4 are corrections. So we're going to have a wave 4 correction, and then it'll go into wave 5, which is just wave 3 in the big process. This may take until 2012, by the way. And let's say the Dow tops out in May, not the Dow, but the HUI, the XGD, and the UserX. Let's assume that they top out in May of 2012. Then you'll get a decline until 2014. You'll get a 2-year consolidation till 2016. And then you'll get another explosive 5-wave rally. And this will be a global mania for the stocks. This is where stocks that in 1996 that were trading at 5 to 7 cents ended up trading at multiple hundreds of dollars. Wave 5s are incredible because it becomes a global mania. The problem with the gold market is it is so small that when everybody wants in, wow, that you know, if 50 people try to go through one door, I'm sorry, but it's not going to happen. The whole wall's going to get crashed down. This was the interesting thing right here. In the 1971 to 1980, I'm just making sure you can read that, 66% of the entire move took place in the last 16 trading days. So in a 9-year bull market, 66% of the gains took place in the last 3 trading weeks plus a day. That's very important to remember, because that's where you may sell a stock, just say hypothetically, at $30, but you just can't understand, my God, 3 or 4 days later the stock is at $40 and then $50. This is what will happen at the end of the cycle. Just something nice to look forward to. And this is quite a well-known Elliott wave tactician who's had a price for many years now publicly of the price of gold reaching at least 6,000.